Good morning, good afternoon, good evening. You are watching the Paris Fintech Forum Communities video interview series. I'm Elliott Gotkine, and today I'm joined by the co-founder and CEO of PeerStreet, Brew Johnson. Great to have you with us.
Great to be here, Elliot. Thanks for having me.
Okay, so before we get cracking, we're going to learn a little bit more about PeerStreet. So you're a P2P investment platform for real estate debt. Is that a kind of reasonable summary?
It's fairly reasonable. I mean, it's not just P2P, it's institutional buyers and individual investors can access these alternative real estate investments through the platform. But the idea behind PeerStreet was the idea that you have a lot of very interesting assets, especially in the real estate world and the real estate debt world, highly historically very fragmented markets. So if we create a platform that aggregates up a bunch of these what we consider high quality real estate backed loans and make them investable, easily investable through a digitized platform for individuals and institutions, kind of the whole ecosystem wins. And so, the idea is, we like to focus on the individual investor, but demand on from the assets come from a variety of different types of investors, from individuals to family offices to major institutions. And the idea behind so the idea behind the name Peer Street wasn't necessarily peer to peer. It was more the idea that leveling the playing field between Main Street and Wall Street, and that anybody could be a peer of somebody at Goldman Sachs or Blackstone by being able to access the same assets and be able to use tools in a way that are like institutional type access.
Okay, and talk to me about traction, growth, revenues, and path to profitability, if that's relevant.
Yeah, so well, we've financed about $5 billion worth of loans through the platform from investors like digitally investing in these real estate assets, and that's by either buying whole loan participations or digital fractional pieces of loans. Um, we don't discuss our revenue numbers publicly. And then obviously in this interest rate environment we're in, there's kind of carnage. There's a very strange environment we're in. Things are kind of lumpy here, but the idea is like, path to profitability in the next 2 years, get ready to go public and go be IPO in the next 2 to 3 years. If you talked to me in December, a year ago at this time, I'd say profitability in 12 months and getting ready to go public in 2023. But the world and environment may have delayed that a little bit.
Okay, and of course, as you say, fintech has been well and truly whacked by the plunge in valuations and the rising cost and scarcity of capital. So I guess that's kind of one of the ways it's affected Peer Street. We see a lot about, I know, layoffs and hiring freezes and cutting costs. Is that something that you're having to do?
Yeah, it is. I mean, I think in this environment where there's a lot of uncertainty, I mean, I think if you thought of going into the year, I think inflation and interest rates were on everybody's mind. I know in my first all hands of the year in January, January 4th, I said, "Hey, here are the three things that are giving me kind of pause that I want us to pay attention to coming into this year. Inflation, interest rates, what that will do to potential property markets and the markets out there, and then a lot of late cycle behavior that I thought you saw going on in the crypto and NFT markets at the second half of 2021. Needless to say, I was not expecting the what was going to go on with, you add in the war in Ukraine, you add in interest rates spiking incredibly quickly. The environment changed very quickly, and then obviously that continued drawdown in public market fintechs, prop tech, any tech company really meant that you went to this perfect storm almost of like slowing market, business slowing, and also that idea of like, okay, like fundraising environments getting more challenging. So at that point, it's like just very prudent to extend runway. And so we've gone through layoffs and furloughs, and we have definitely reduced costs, because the idea is like we think that actually a platform like PeerStreet really benefits from an adverse, like a bad market, basically, because what tends to happen in bad markets is traditional liquidity or capital sources go away. So a distributed technology platform actually creates a big benefit of people, borrowers being able to access properties for access capital to buy properties and do the projects, investors finding places to allocate capital to that is relatively potentially safe and or delivers a return when there's a lot of volatility. So we're seeing great activity, but the fact of the matter is, if we hired aggressively at the end of last year because we were going to be profitable, those kind of magic numbers of 100 million of net revenue, profitable, growing significantly, getting ready to go public, and the environment changed. And so look at revenue revenue will be down kind of year over year this year versus where it was. Market has slowed, but I feel like we're in a transition period, especially in the last couple months, where as this transition period settles a little bit, we are actually very optimistic and bullish, even if the market stays fairly negative for the foreseeable future.
And one of your early investors, I think, was Michael Burry, one of the stars of The Big Short. Is he still a shareholder, and what does he think about the current situation? Has he given you some advice?
He is, and we generally talk every 3 to 6 months in advisor call and meetings. We actually last time we spoke was kind of before a lot of the carnage that started happening with the rising interest rate environment. And I don't want to speak for I don't want to put speak for Dr. Burry or any of our other kind of third parties, but yeah, I think if anybody follows him on Twitter, I think they would see that he is pretty, pretty. If you follow him on Twitter, I think it would be categorized as saying he's very negative on the kind of on the environment. And if I were to say like I think my sense is that he feels we're potentially in a period of like a 2001 to 2003 period where the markets were kind of down for a long period of time. And I'm not quoting him directly on that, but if you just some other factors and conversations we have, and I just saw recently that he sold almost all of his long holdings in his hedge fund. That was like a public filing. So that's one person's point of view. I would probably say that I would lean more to that kind of bearish side of things generally. But yeah, I have other advisors, investors who are financial advisors who think that the economy is that things are going to be just fine. So got to balance it all, and everybody has to make their own decision. I personally would lean a little more towards the bearish side, I think.
I was listening to a wise person the other day saying you don't want to put your money with pessimistic people. So look, we've heard about PeerStreet. Let's now get to know Brew a little bit better. So, Brew, like many founders, Brew, you started off life as a lawyer. Why the switch to being an entrepreneur?
I was of the I was always an entrepreneur. I when I went to law school, I probably fell into the camp of like not really sure what I want to do. I know I want to be an entrepreneur someday, but if I look around and see like a skill set that I think could be useful in a lot of different areas of business, and if you decide to stay in law, that's a great thing. But it's also something applicable. A lot of the most successful entrepreneurs that I personally knew, which was a smaller set, had been lawyers and then moved from the legal world into the whether it was real estate world or startup world or business world. And so I'd be lying if I said like I went to law school for this specific reason. I knew I wanted to be an entrepreneur, had that entrepreneurial gene from a young age, and went to law school. I was like, okay, until I figure out that right thing to do, I think this would be a great thing. And quite frankly, for me personally, it was an incredible experience and a great way to start my career. I got exposure to a lot of things that you use in every day as a founder. So for me, it was great. For a lot of people, it may not be. Yeah,
Right, because
yeah.
I know a lot of founders kind of try and they become lawyers and then they spend their time trying to escape from being that. But I guess you had it in your mind all along that you were going to be an entrepreneur. And before you made that kind of career choice, or that, I mean, you gave yourself a bit more time as well. I think by living and working in South Africa, you were kind of traveling around the world a bit before you I don't know, settled down a bit.
Yeah, and I think that's another thing that's an entrepreneurial thing that I think is really interesting. There was this professor at USC that actually ran the entrepreneurship program there for years. And USC is a college here in LA that, my brother, when I was in high school, took me to this lecture that this guy did on entrepreneurship. And his advice to people in the class were like, hey, if you're an entrepreneur, I would spend your 20s going and doing something that you find enjoyable. Don't If you want to be an entrepreneur, don't go get a job right out of college, because then you tend to get in the rat race of the career progression ladder. But if you're an entrepreneur, go out and see the world, go do something that's interesting, and quite possibly along the way you will find something that drives a great entrepreneurial endeavor. You might find that problem to solve, or that thing that you're really, really passionate about. That was his lecture in college, and it was amazing. So I took that as advice. So after I graduated from college, I went and traveled the world, and I'm lucky enough to get a job in South Africa. In travel basically the world for about a year, and then came back and then went to law school. And I actually think that that experience of traveling was actually very, very, I thought it helped in a lot of different ways. And that's like a piece of advice I give to some aspiring entrepreneurs that may not be the typical advice. Is that like, hey, I'd actually go do something that is interesting to you while you're young, because you'll learn about people, you'll learn about the world, you'll learn about negotiation, all these sorts of things, and you actually might find that thing that is interesting to you. Now, for me, going to law school and then working as a lawyer actually was the thing that really had the aha moment, and was what caused me to want to start PeerStreet. Because working as a lawyer, I was working as a real estate lawyer out of the dot-com crash and then during the housing bubble. And it was always just very, very frustrating to me to see out there that like all the inefficiencies in the system, all the costs in the system, whether that's from legal intermediaries, all sorts of different things. And then also the fact that it was very, very difficult for the average person to access a lot of investments out there that I saw was that I thought would be great. And so the idea behind PeerStreet from day one was like, okay, how do these things work out there in the regular world in terms of how deals are financed or how people access investments? And if you could use technology to basically disintermediate and then replace people with software, well, there'd just be a huge amount of value unlocked that then would get distributed out to the average person more efficiently. And again, we are in the real estate loan world, so I always use and you mentioned Michael Burry. I always go to the mortgage-backed securitization world, because when I was a lawyer, I became obsessed with the securitization market and everything was going on there, and ended up shorting the markets before financial crisis because of all the mess in that system. But if you break down that system, what happens there is that like, you know, mortgages are made, they're turned into bonds, they're sold off, and those things make their way down to pension funds and retirement accounts. And pretty much everybody owns mortgage-backed securities, which is a mortgage-backed security is an investment in a real estate loan, really. But by the time all these loans go through all these intermediaries and all of these third parties kind of take a pound of flesh, most of the yield that borrowers are paying gets extracted by these third parties in the middle. And that's the beauty of a technology platform. And that's like really what I think a fintech or a prop tech should do. It's like, okay, let's cut out the costs here and distribute the value that you save out to the users. And so that's the goal of PeerStreet. And so if you can connect borrowers more efficiently to capital, and that capital can get access to these investments more efficiently, you can unlock a lot of value for those participants, and also I think society going forward. Now it's a big, massive challenge, and so when going after it, it takes a long time to go after it. And like we've made a lot of progress over the years. We have a long way to go, but.
Right. Well, sounds like you and Michael Burry have that in common as well, going short on the on mortgage-backed securities before the financial crisis.
So you're
I need to move on to the next. Sorry, bro. I need to move on to the next section, because a key part of this interview is to get your take on the future of finance. But first, we're going to take a very quick break, after which we're going to continue our conversation with PeerStreet co-founder and CEO Brew Johnson. Welcome back, and don't forget, if you're not already a full member of our community, everything you need to join can be found at www.parisfintechforum.com. Okay, now Brew, let's talk about the future of finance. We've talked a bit about real estate, and as you mentioned, it's been soaring in so many of the world's major cities, and yet they haven't fallen yet. We've seen financial markets plunging, we've seen interest rates rising, we've seen inflation soaring, we've got geopolitical tensions, and yet real estate, certainly in the likes of, in most parts of the US or in London or here in Tel Aviv, they still seem to be very robust. Is a decline inevitable? Is a similar kind of fall coming to the one that we've seen in valuations of fintechs and startups? Is that inevitable?
Well, I don't know that you have the extreme in real estate with that. There's a real asset there that is a usable, productive asset in most cases, and that something somebody can live in or use. And I think it's very market driven in terms of what can happen in real estate. Now, I think while price declines have not picked up or shown in kind of the macro data, I think if all the indications in the micro data we get from customers and data that we see is there's a lot of markets that are going down in value, where that's 1% a month or 2% a month in certain areas in the states. But I think it will be a very market by market basis. But I mean, anytime the interest rates go up that high, affordability changes, the ability to buy or finance property, the cost of it goes up. The way markets obviously work is costs go up, prices generally come down to fit that. Real estate's a unique one. And in the different parts of real estate, especially housing, you have this counter aspect, at least in the United States, where there is a housing shortage due to the numbers, and you have wage inflation going up, so rents are going up to support things. So there's a lot of cross currents going in, but I just generally think that like real estate is not a market that you should be seeing 20 to 30% gains annually. And when you have that rising rate environment coming in after the fact of very high price increases, we would assume softness in a variety of markets, especially markets that were a little more rural and saw spikes over the last couple of years with all the stimulus that flowed in the market. And then the last piece I'd say is like residential real estate, which is where we focus, to me, or would be the safest port in the storm. And even if you see downturns in it, I think or price declines, I think the relative price declines would probably potentially offset price declines in other assets that may have been overinflated as well. And then but then like assets like commercial real estate, I think there's still a lot of question marks because there's still a lot of people not going back to offices. It's going to be really interesting to see what the vacancy rate in commercial buildings go due to valuations going forward. But I would assume there's going to be pain in certain markets, both certain micro real estate markets, like residential markets, as well as kind of asset class markets like commercial. I would see there being pain in different areas there potentially.
And we discussed this a bit. You talked about one of the goals of PeerStreet was to make, your average Joe a peer of someone at Goldman Sachs. So some people kind of, use the word democratizing kind of different bits of financial services, bits that were previously only available to those with deep pockets and or connections and or institutions. But do you feel that there are some areas that ought to be just reserved for sophisticated investors? I don't know if real estate mortgages is one area. Should they be restricted to those who are either institutions or should have less to lose? In other words, is the democratizing of these bits of finance, is it universally good? Is it uniformly good, or are there some areas where it's gone too far?
Yeah, well, yeah. So which might be a little counterintuitive to a startup founder, where you want to think of new ways to do things and broaden and democratize things, like you said. But look I'm not an anti-regulator. I think that actually it makes sense in a lot of areas. I just think I think where I think fintech or entrepreneurs who are trying to start things and do things new ways, like when that regulation doesn't line up with the end goal of kind of like whether it's wealth creation or that. I think the worst part of it actually when when the regulation or may limit access in a way that actually um, um, negatively impacts one group versus the other. And so I think there is areas where there should probably be oversight. But I think the part that I think is kind of wild to me is like we only allow accredited investors on our platform because to access non-accredited investors, it would be a difficult thing to do. Now, at the same time, a non-accredited investor could go buy a lottery ticket or could go on Robinhood or a stock market and make aggressive options trades and things like this. So sometimes the most regulated, highly regulated part of the markets kind of have this very, very speculative aspect to it. And it's like, how do you make the determination of like what is appropriate for an individual investor? I personally feel that the current regulations in terms of like how things are, how access to investments are allowed for investors seem to me to like carve out a large part of the population that either should be sophisticated enough or smart enough to be able to make a decision, or um, be able to like take the risk of learning by doing. but yeah, so I think regulation makes sense. I think the idea of limiting access to certain things makes sense. But my God, the last 2 or 3 years, we are in a regulated, we are highly regulated. We only allow certain types of investors. We can't go talk about the actual investments because we go under a 506B. So we don't market the individual investments. But man, the past few years have been rough because you see people out there like pumping up crypto and NFTs and Bitcoins, which to me was like seemed very, anybody could access those things and people lost tons of money. Whereas like, so I think regulation plays a part, obviously. And I just think it's like, I think giving more options to more investors is good. I think the idea of educating investors is good, and putting safeguards around things always makes sense. I just think the idea sometimes the safeguards might impact certain parts of the market more than others, and maybe those parts that are impacted actually could be better for a lot of investors. So I don't think there's a perfect way to do it, but I think regulation is good. But I think you need regulation. But I think it counteracts some of the benefits that could accrue out there to the market.
Okay, so it's time now for our round of rapid fire questions. Are you ready, Brew?
I am.
Okay, great. So I've got 90 seconds on my phone. One word answers is all I'm after, and we'll try and get through as many of these as we can. So away we go. What fintech segment besides yours has the biggest potential over the next 5 years?
Consumer.
What is the biggest pain point in your everyday financial life that you'd like to see resolved?
Payments.
Are we at the beginning, middle, or end of the fintech wave?
Beginning.
Do you have a metaverse strategy?
No.
Have regulators in the EU and US kept pace with all the new possibilities and behaviors in the financial industry?
No.
How would you describe NFTs? A scam, B, an interesting concept, or C, part of the future that we really don't want to miss out on?
All of the above.
Have you personally ever invested in crypto?
Yes.
Are physical points of sales part of the future of finance?
Yes.
On a scale of 1 to 10, 10 being the most likely, 1 being the least likely, how probable are the following likely to happen in the next 10 years? That one of the neobanks will be as profitable as a top-tier legacy bank?
7.
CBDC, central bank digital currencies, become a mainstream reality in the US and EU? Or EU?
3.
You'll be able to open a crypto account at a top-tier bank?
5. No, that's an 8.
Okay,
That's an 8.
Fine. Well, look, I'm afraid we've run out of time. So I really just want to thank you, PeerStreet co-founder and CEO Brew Johnson, for joining me today.
All right, Elliott, thank you so much. It was good to see you. Hopefully see you in Paris in person sometime,
Likewise. And for everyone watching, we will be back again next week with another big name from the world of finance and technology. We do hope you'll be able to join us again then. In the meantime, don't forget to subscribe to the Paris Fintech Forum YouTube channel and to follow us on Twitter at Paris Fin Forum. That's all for now. Hope to see you next time. Bye-bye.